Just kidding, there's no secret loophole. But what we are going to do today is we're going to cover some things that I think every W 2 employee should do to lower their taxes. And let's get into it. So, the first thing is so obvious it's the tax deferred retirement accounts. What does that mean? Your traditional IRA, your 401k, your 403b if you're a government employee. All of these are a great way to lower your taxable income. And not to mention save for retirement, especially if your employer does a percentage match. So sometimes the employers will do like a 3% match up to a certain amount. So what that means, it's free money, guys. It's free money. So what do you mean it's free money? Well, it's free money because they're going to give you money for free. They're going to match to a certain percentage of whatever you decide to put into your retirement account. They're going to match up to a certain percentage or match. Every employer has different rules. So you get bonus money to throw into the market to invest. Not to mention you get a tax deduction for it. And it grows tax free, although whenever you withdraw the money, you're going to have to pay taxes. But that's why it's called tax deferred. You don't pay now, you pay later. So those are big things. Another thing I've covered in a previous video is contribute to your HSAs. So what is an HSA? Go watch the previous video. Maxing out the HSA on top of already contributing to your retirement accounts that are tax deferred. That is a great way to lower your taxable income as a W 2 employee. Here's something that's unpopular, but you're going to want to hear this. Make estimated tax payments. If you're tired of owing every year, you have this big balance due, it's most likely because your W-4 is wrong. What is a W-4? Your W-4 is a little thing you fill out whenever you first get hired, and you're excited because you just got the position, and you just complete the thing as quickly as possible because you're sick and tired of paperwork because you've already went through all of your health insurance plans, your retirement contribution plans, understanding how all this works, what's best for your situation. You get to the W-4, and they have made it so complicated now that it takes almost a PhD to fill out W-4. It's so dumb. But that's kind of my side tangent rant. But anyways, make estimated tax payments. Consult your tax advisor. Tell them, hey, you want to make estimated tax payments. All you gotta do is call them, email them. They'll prepare them. It's not that hard. Making estimated tax payments is so easy, and it's the best. I mean, not the best way because I would argue, retirement accounts are a better way because you're getting something for it. The estimates are you're just paying in to the government, like quarterly or however often you choose, rather than kind of waiting to the end of the year to have this $10,000-$15,000 balance. And everybody hates it, and everybody is mad at their tax preparer. I can't tell you how many times people have been upset with me, or they just don't understand why they owe, because it's different. Every year is different. So that's one thing. Planning with your tax advisor or whoever is preparing your returns, whether it's your EA, your CPA, or using TurboTax. Google, how do I prepare estimates on TurboTax? I'm sure there's a link. It's not super difficult. The next thing is to use a 529 plan. This is pretty good. I really like 529 plans because, especially if you have kids, it sets you're contributing, getting a tax deduction, and the 529 plan allows you to grow tax free, and you get to withdraw the money tax free as long as it's used for a qualified secondary education, i.e., college. So basically, you throw money in this account for your kid's college fund, you get a tax break. Whenever you withdraw the money, it's tax free. Just like an HSA, but instead of the prerequisite being health, withdrawing the money for health needs, it's, hey, this is for college or some post secondary education. The next thing is, speaking of college, don't forget to record your student loan interest and many other what they call above the line deductions. So this is kind of a gimme, to be honest, but it's just making sure that you're aware of the deductions that are available to you. That's why it's so important to fill out the organizer correctly with whoever's doing the tax return. And if you're self-preparing, you need to look this up. So, let's just kind of go do an example right now. I'm just on Google. above the line deductions, and it gives you a whole host of things. So there's educator expenses, self-employed. If you have like a Schedule C, side hustle or a business that goes on the Schedule C, make sure you're deducting your portion of the self-employment tax. That's also where all of your IRA, your HSA contributions are going to be listed on the tax return. Your charitable contributions, all of that stuff is going there. So that's another way you can lower taxable income as a W 2 employee. But guys, there is no magic potion. There is no, people that make $1 million on a W 2 are doing differently than, there's nothing that's available to them that is not available to you. There's no magic pill or magic potion that just makes their taxes go away. There's just not. So, don't feel as if, uh, the rich or the 1% are doing something that you can't do or is not available to you. The last thing that's kind of obvious too, make sure you're calculating your credits right. Your child tax credit, that's pretty obvious, pretty easy to calculate. The earned income credit, if you're in a lower income tax bracket, make sure that that is correct. That is a very complicated tax credit and it's a refundable tax credit. Um, so that's so important that gets right, especially if you're filing on your own through TurboTax. Make sure that is correct. Also, the education credit, something I see all the time, is let's say let's do an example because this is better used as an example. Is education credits, the American Opportunity Credit specifically. So let's say I don't know, you spend $10,000 in education credits, or let's say you spend $10,000 on tuition, and little Johnny and Susie are both going to school. They're both going to be freshmen at Oklahoma University in Norman, Oklahoma, which is great. And they are, they're going into their freshman year. You pay, their tuition on their behalf because obviously little Johnny and little Susie are not going to be able to afford that on their own. And they're not going to be able to be self-sufficient. They can't support themselves. So they can still be claimed as your dependent up until like age 24. So what happens is little Johnny and little Susie, they're independent now, right? So whenever they're going to go file their tax return, and what happens a lot of the times is they will claim the education credits and they will get back, the $2,000 of education credits, and that's great. That's awesome. Little Johnny and little Susie got back their education credit. The American Opportunity Credit, you get 4 years to claim that. Then it switches over to the Lifetime Opportunity Credit, which is different, but it's calculated different. But right now we're focusing on just the American Opportunity Credit. So what happens is little Johnny and little Susie claim themselves. They mark the box on the tax return. I cannot be claimed as a dependent. The parents go and file, and they're like, what the heck, the tax preparer comes back and says, hey, your return got rejected because little Johnny and little Susie claim themselves. And that especially sucks whenever, it's a situation where the parent is single or, divorced. So for tax purposes, the difference between filing as single and head of household, being able to claim little Johnny and little Susie as dependents is really, really important. For different tax brackets that they'll fall into for the standard deduction, really. But also the education credit that they will be able to claim. So make sure you talk to your kids. Don't claim themselves. I know that they want to go out and be independent, make their mark on the world, and they're out there to get their education. That's wonderful. Don't file as mark the box. Don't tell them not to mark the box as dependent on their tax return, so you can get the education credits. So those are some things that you can do as a W-2 employee that will lower your taxable income. There's not a secret loophole. Most of us just doing what we're supposed to be doing. The boring stuff works. It's boring because it works. There's no magic pill. Tax deferred accounts. Make your estimated payments. Fill out your W-4 correctly. Talk to your kids about claiming education credits. Make sure your education credit, or make sure your earned income credit is filled out correctly. And don't forget to claim certain above the line deductions. Awesome. Take care. I'll see you in the next one.